Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at SpaceX.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and right before we get into the actual analysis, just a quick heads up about a really useful chart tool for you. If you want help reading trading charts a bit more clearly, you can check out VIP Algos through the link below in the description.
Right, it's a TradingView indicator suite, which is super handy.
Exactly. It shows visual buy and sell chart alerts, trend direction tools, and even support and resistance zones.
Yeah, and it helps with take profit and stop loss planning areas too, which you can use across markets like, stocks, Forex, crypto, gold, futures, pretty much everything.
Just remember, VIP Algos is purely an educational chart analysis tool. It is not financial advice. It does not place trades for you, and it definitely does not guarantee profits.
Right, because trading always involves risk. So, always manage your risk and do your own research.
Yep. And just for full disclosure, that is an affiliate link in the description, so we may earn a commission if you use it at absolutely no extra cost to you.
Okay, so let's get into it. $2.1 trillion.
Wow.
Trillion. With a T.
Yeah.
That is the staggering price tag SpaceX just exploded onto the public markets with this week. Trading under the ticker SPCX.
Yeah. Debuting at $135 a share, and it has just, it's absolutely dominated the tape.
It really has. But what's truly wild here isn't just the sheer size of that number. It's how the market is completely redefining what this company actually is. It's no longer being valued as just a rocket manufacturer. It's being aggressively grouped into this new basket of tech giants. People are calling it mangoes.
Mangoes, yeah. Meta, Anthropic, NVIDIA, Google, OpenAI, and SpaceX.
Right, and that is a huge shift. So they're looking at it as an AI infrastructure leader now.
It's a seismic shift in market psychology, honestly, because for decades, traditional aerospace and space exploration were viewed by Wall Street as just absolute cash incinerators.
Oh, totally. Massive capital sink.
Exactly. Completely dependent on government contracts.
Oh.
But by putting SpaceX in that mangoes basket, the market is signaling, hey, we don't view this as an aerospace contractor anymore. We see it as foundational AI infrastructure.
Right. But if you're building a growth portfolio right now and you're looking at that $2.1 trillion valuation, you really have to wonder how a space stock fits into a traditional long-term strategy.
For sure.
Is grouping them with NVIDIA and Google just hype? Or is there a genuine wealth-building context here for you as an investor?
Well, for a serious investor looking at long-term horizons, this is basically being modeled as a multi-year hold. You're targeting the convergence of two massive secular trends here.
Which are?
Global broadband connectivity and artificial intelligence. They aren't just, exploring space anymore. They are straight up industrializing low Earth orbit.
Yeah, that makes sense. I've actually been rolling this historical analogy around in my head all week. It feels remarkably similar to the railroad monopolies of the late 19th century.
Oh, that's an interesting way to look at it.
Right. Think about the massive wealth generated by the Union Pacific. They didn't make their real money just by renting trains back and forth.
Yeah.
Their true value was that they built the only physical tracks to the new western frontier.
Right, the infrastructure.
Exactly.
Yeah.
If you wanted to move goods, if you wanted to participate in that whole new economy, you had to pay their toll.
Mm-hmm.
And isn't SpaceX essentially doing the same thing? Building the only reliable tracks to the orbital frontier?
Yeah, and in this case, those tracks are cheap, reusable, mass-to-orbit rockets. It makes them a pure infrastructure play.
Yeah, and building on that, the true power of a railroad is its monopoly on the route. Right now, SpaceX has achieved this unprecedented, vertically integrated orbital constraint. Nobody else owns the complete logistics chain from the launch pad to orbital deployment at this kind of scale or at this price point.
No, nobody even comes close. It gives them the exclusive ability to deploy heavy physical infrastructure into space for a fraction of what legacy aerospace companies charge.
But, okay, the railroad analogy sounds great in theory. But laying physical tracks across a continent was notoriously expensive.
Yeah.
And a lot of early railroad companies just went completely bankrupt doing it.
Oh, absolutely. It was a bloodbath.
So let's look under the hood at the fundamentals. Are they actually generating real cash from this orbital monopoly, or is all their capital just burning up on the launch pad?
Well, the 2025 financial trajectory reveals a business growing at hyperspeed. But the revenue mix is where the story gets really, really interesting.
Okay, let's break that down.
So total revenue surged to $18.7 billion, which represents a massive 33% year-over-year growth rate.
Wow, 33%.
Yeah. But the absolute star of the portfolio, the true cash engine that's funding all of this, is Starlink.
The satellite internet division.
Correct. So Starlink brought in $11.4 billion in revenue. That is up 50% year over year.
50%, that's insane.
It is. And it now makes up 61% of the total company revenue. But here is the number that is dropping jaws across Wall Street.
Let's hear it.
Starlink's adjusted EBITDA margin sits at an incredible 63%.
Wait, I want to pause on that for a second because adjusted EBITDA margin gets thrown around a lot in financial media. For you listening, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
It's basically a way to measure a company's core operating profitability before, all the accounting and financial technicalities get in the way.
Exactly.
But 63% is exceptionally high for a hardware-heavy business. How are they achieving software-like margins on physical satellites?
It all comes down to the mechanics of orbital infrastructure. So the initial cost to design, build, and launch a constellation of satellites is, well, it's astronomically high.
Right, rockets aren't cheap.
Exactly. But once those satellites are actually up there, the marginal cost to add one new subscriber down on Earth is almost zero.
Oh, I see. They just ship a terminal and turn on the signal.
Yep. So as their subscriber base scales up, nearly every new dollar of revenue drops straight to the bottom line. And that resulted in $4.4 billion in segment operating income.
Okay, so Starlink is pretty much printing money. But what about the core launch business, the Falcon 9 rockets that are actually hauling all this stuff up into orbit?
Right. The launch segment is completely dominant. They capture 100% of the task orders for critical U.S. national security space launches.
Wow. Literally a monopoly there.
Pretty much. They completed a record 165 Falcon 9 flights in 2025. But that segment only grew 8% year over year.
Okay, so it's a bit slower.
Yeah, it's a mature, reliable cash cow. To use your analogy from earlier, the Falcon 9 is the delivery truck. Starlink is the highly profitable cargo.
I hear that, but looking at the broader balance sheet, I have to push back a little here.
Okay, go for it.
There is a glaring red flag. The company posted a $4.9 billion net loss for the year.
Right.
And in 2024, they actually had an $800 million profit. So they swung from profitability to a massive multi-billion-dollar bleed in just 12 months. If Starlink is generating all this operating income, where is all the cash going?
That is the big question. Traditional value analysts are zooming in on that exact metric. And to understand it, we really have to look at the causality behind the loss.
So it's intentional.
Very intentional. It's a deliberate, highly aggressive capital expenditure strategy entirely focused on their AI segment. That division posted a $6 billion operating loss.
That's billion, wow.
Yeah, driven by $12.7 billion in capital expenditures.
Okay, wait. So they're building data centers in space.
Yes. They are building what they call the Colossus orbital data centers.
We have to unpack the why and how of this.
Yeah.
Because shooting servers into space sounds like science fiction. Why would anyone pay to process data in orbit when you can just build a server farm in, like, Texas?
Because it solves the two biggest physical bottlenecks in artificial intelligence right now: electricity and heat.
Oh, right. Because AI needs so much power.
Exactly. Terrestrial AI data centers require so much power, they are literally overwhelming local power grids. And keeping those GPUs cool requires millions of gallons of water.
So how does space fix that?
Well, in low Earth orbit, you have access to unadulterated 24/7 solar power without any atmospheric interference. Plus, the vacuum of space provides an ambient environment that naturally assists in thermal management. You bypass Earth's grid constraints entirely.
That is wild. But, I mean, a $12 billion burn rate to build it is still terrifying for a public company. How are they keeping the lights on while they build all this out?
Two ways. First, they just raised $75 billion in this IPO, so they have a massive war chest.
Right.
Second, they aren't building these data centers on speculation. They have already locked in $26 billion in annualized compute revenue.
Wait, $26 billion already locked in? From who?
Yeah. Anthropic is contracted for roughly $1.25 billion a month, and Google is paying about $920 million a month, locked in through 2029.
Okay, so the current cash flow is deeply negative, but They have ironclad contracts that will rapidly reverse those AI segment losses once the orbital servers come online.
Precisely.
That naturally brings us to the catalyst timeline, because as an investor holding this stock, you really want to know when these massive capital investments will actually bear fruit. What did the execution runway look like over the next few quarters?
So the next 3 months are highly sensitive. First, the inaugural public earnings report is slated for late summer 2026. The market will be laser-focused on Starlink subscriber progression.
What are the targets there?
Management publicly guided a goal to jump from 12 million subscribers to 25 million by the end of the year.
Doubling the subscriber base in half a year. That's aggressive. If they miss that mark, a stock trading at this kind of premium will get punished.
Severely. Any miss there is going to hurt. Then we also have a major macroeconomic hurdle. The June 16th and 17th Federal Open Market Committee meeting, the FOMC.
Right. And just to connect the dots for you listening on why the Fed matters for a space stock, when you have a high multiple, long-duration growth stock like SpaceX, a huge portion of its $2.1 trillion valuation is based on profits that won't materialize for years.
Exactly.
And interest rates act like gravity on those future earnings. When rates are high, future money is worth less today.
Yeah.
A dovish hold or a rate cut by the Fed reduces that gravity, which would be incredibly favorable for maintaining the stock's post-IPO momentum.
Spot on. The macro environment sets the stage, but the most critical fundamental event, the true binary catalyst that will dictate the company's future, is the Starship Block 3 commercial payload delivery.
And that's scheduled for when?
The second half of 2026.
Okay, Starship being the massive, fully reusable rocket they've been testing.
Yes. It actually completed its first V3 flight back in May. But proving a rocket can fly empty is entirely different from successfully deploying a massive commercial payload into orbit.
Right.
The entire economics of the Colossus data centers rely on Starship's ability to lift unprecedented amounts of mass into space at a radically reduced cost per kilogram. If Starship fails to deliver commercial payloads reliably, the whole orbital AI thesis just falls apart.
And this is where the skeptic in me really has to speak up.
Yeah.
Is that Starship's success already priced into this valuation?
Yeah.
Space exploration is notoriously prone to delays.
Very true.
I mean, timelines slip, valves freeze, rockets blow up. If you are buying in right now, aren't you essentially paying for flawless execution on a vehicle that hasn't fully proven its commercial reliability yet?
That tension is the absolute central debate on Wall Street right now. And to understand why the stock is holding this valuation despite the execution risk, we really have to pivot away from the rockets and look at the actual trading chart.
Okay, let's talk about the technicals.
Right, because the price structure and the supply-demand mechanics of the stock market are driving this equity far more than the fundamentals at this very moment.
Yeah, because what is happening with the shares themselves is fascinating. You are looking at a technical phenomenon called engineered scarcity.
Exactly. The company structured this IPO so that only about 4% of its total outstanding shares were floated, meaning made available for the public to trade.
4%. For a company valued in the trillions, a 4% float is microscopic.
It creates a massive imbalance. The IPO drew over $70 billion in retail orders from investors desperately trying to get a piece of the action, all of them chasing that tiny supply of shares.
Just fighting over scraps.
Yeah. And adding to the squeeze, there is a tiered lockup structure for company insiders. They're explicitly rewarded and can only sell their shares if the stock holds above that $135 debut price.
So they have no reason to sell right now.
None. It creates a structural and psychological floor where insiders are highly incentivized not to dump their shares.
I want you to picture a massive stadium. Tens of thousands of people are packed inside, but there is only one small exit door. When everyone rushes that door at the same time, the pressure is immense. Right now, everyone is rushing the buy door for a stock that barely has any shares available.
It's a pure supply and demand mismatch.
And what happens when structural institutional money is forced to enter that picture?
The pressure goes parabolic. MSCI, which manages some of the largest global equity indexes, confirmed that SpaceX will enter its global standard indexes on a T+1 basis.
Let's define T+1 for you listening. That means the index funds have exactly 1 day after the trade date to settle the transaction. They literally don't have the luxury of waiting for a dip.
Right. They are forced price-insensitive buyers. An index fund manager doesn't care if the valuation multiple is historically absurd. Their mandate is simply to match the index.
Wow.
So you have multi-billion-dollar institutional funds rushing into an order book that already has over $150 billion in unfilled demand, all trying to extract shares from a 4% float.
That explains the crazy price action. But it also leads to a very strange market psychology. What does this sentiment look like when a stock is essentially being forcibly bought, regardless of its underlying financial reality?
Highly, highly polarized. You essentially have two completely different markets looking at the exact same tick symbol. Traditional value analysts are staring at a valuation of over 109 times sales.
Okay, let's contextualize that. Meaning investors are willing to pay $109 today for every $1 of sales the company makes over the course of a year. For context, a typical healthy tech company might trade at 10 or 15 times sales. 109 is astronomical.
Right. To a value investor, that means there is zero margin of safety. Like, none. Any operational hiccup could trigger a catastrophic repricing.
But there's another side to that.
Exactly. On the
Yeah.
completely opposite side of the spectrum, you have momentum investors and major institutions like Oppenheimer. They actually initiated coverage calling the stock undervalued at its $135 debut price.
Calling a $2.1 trillion company undervalued is a very bold thesis. What is their justification for that?
Their argument relies entirely on the concept of TAM, or total addressable market. They're looking at the $26 billion in contracted AI revenue and projecting a $10 trillion TAM for orbital infrastructure over the next 2 decades.
Wow. So they're looking way into the future.
Yeah, they aren't valuing SpaceX as a rocket manufacturer. They are valuing it as the sole toll collector for the next iteration of the global internet and AI compute.
I saw a news headline recently that perfectly captures how dangerous this divergence can be.
Yeah.
It read, SpaceX is no longer a company, it's a belief system.
Oh, that's a great way to put it.
And if you're managing your own portfolio, that should be a massive caution flag. When a stock price is driven purely by momentum and a collective belief in a utopian future state, rather than present-day cash flows, the ground underneath you can vanish overnight.
The vulnerability in a belief system is that beliefs can change rapidly, which makes mapping out the risks and the bear case absolutely critical before you even think about allocating capital.
So let's tear down the bull thesis. Where are the actual cracks in the armor?
The most immediate risk is that same 4% float we just discussed. Engineered scarcity is a double-edged sword. Yes, it creates explosive upward pressure when everyone is buying, but if the hype fades, or if a Starship test fails catastrophically and sentiment sours, that thin float amplifies the sell-off on the way down.
Right.
If everyone suddenly decides to run for the exit, there simply aren't enough buyers to absorb the volume. And there is no fundamental valuation floor, no reasonable price-to-earnings ratio to catch the falling knife.
We also have to look closely at the AI integration itself. I mean, the Colossus data centers are an incredible engineering feat, but they imported massive cash burn when they integrated XAI.
Very true.
And recently, all 12 of the original XAI co-founders departed the company.
Yeah, that was a huge blow. A brain drain of that magnitude, particularly in a highly specialized field like artificial intelligence, introduces massive execution risk.
Because they're competing with giants now.
Exactly. SpaceX is now competing directly against terrestrial hyperscalers, companies like Amazon, Microsoft, and Meta, who have bottomless, deep pockets, established infrastructure, and incredibly stable engineering teams. Building servers in space doesn't matter if the underlying AI models fall behind what is being developed on Earth.
And finally, there is the elephant in the room that every SpaceX investor has to acknowledge. Key person risk.
Yes.
The entire $2.1 trillion premium of this company is inextricably tied to Elon Musk. His specific vision, his relentless drive, and his unique ability to raise billions of dollars on a promise.
Yeah, it's undeniable.
If he were to become overly distracted by his other ventures, or if he were to suddenly step away from the company, you have to imagine that the belief system holding up the stock price would just collapse. The whole orbital compute vision ultimately requires his Starship to fly cheaply, frequently, and flawlessly. And as of today, it hasn't reliably proven it can do that.
And that forms the core of the bear case. They are spending capital like a company that has already solved the physics and logistics of orbital compute, but they still have to prove they can operate it profitably at scale.
So with all the pieces on the table, the revolutionary tech, the incredible Starlink margins, the terrifying cash burn, and the microscopic float, w- what is the final verdict here? How do we balance an unassailable orbital moat against extreme valuation risks?
Synthesizing the fundamental dominance with those technical risks, our analysis points to a bullish score of 8 out of 10.
I do an 8 out of 10.
But the target horizon here is firmly a multi-year hold, not a short-term trade. SpaceX is currently the only vertically integrated orbital infrastructure monopolist on the planet. They are brilliantly using their Starlink cash engine to fund a massive, defensible AI data center moat.
Right.
However, the true value unlock for investors will likely take 2 to 3 years as Starship operations scale up to enable high-cadence, low-cost flights. If you are a short-term trader, the thin float and high multiple make this extremely volatile and dangerous. But for a long-term investor, the supply-demand mechanics, combined with $26 billion in locked-in AI contracts, provide a very compelling, albeit aggressive, growth thesis.
Fascinating.
And as we wrap up this talk, I want to leave you with a provocative thought to ponder, something that builds on the implications of this orbital infrastructure.
What's that?
The biggest bottleneck for AI on Earth is the physical power grid. If these orbital AI data centers can truly bypass our terrestrial grid constraints by utilizing raw solar power in space, we might be witnessing a fundamental shift in human infrastructure.
That's a crazy thought.
Right. Could low Earth orbit eventually replace fiber optic cables and terrestrial server farms to become the actual physical backbone of the future internet? It is a fascinating question to consider as you watch this story unfold over the next few years. And just remember, this analysis is for informational purposes only and is never financial advice.
Definitely. And if you want a cleaner way to read trading charts as you track equities like this, be sure to check out VIP Algos through the link below in the description.
Highly recommend it.
VIP Algos is a TradingView indicator suite offering visual buy and sell chart alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It is strictly an educational chart analysis tool only. It's not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
Thank you for joining us for this analysis. If this deep dive helped you better understand the markets, please consider subscribing, leaving a like, and commenting underneath. We'll see you in the next analysis here on Smart Wealth with Joshua.